Hello, I'm Kevin Buddy, a mortgage specialist. The Southern California housing market in 2019 will not be a boom, but it won't be a bust either, and I'm going to explain why. In 2019, the Southern California housing market will continue to have slower sales and smaller price increases when compared to the last several years. The Southern California housing market's been on a nearly 7-year tear, with prices in many communities reaching all-time highs. But now, as mortgage rates rise, the boom appears to be fading. Sales are dropping, inventory is increasing, and more sellers are scaling back their ambitious asking prices. There's been recent studies of the housing market, and some of them predict that annual increases will slow, and other studies have actually stated that values could dip. However, there is a general agreement that a meltdown is not in the offing, given the healthy economy and the lack of inventory. There's little reason to believe a bubble anything like the one that popped in 2007 has formed again. And I'm going to explain why. Before the last downturn, Southern California was several years into a real estate upswing when prices began to accelerate. They increased at double-digit rates for 6 years, fueled by a wave of risky, even predatory lending. Borrowed money could be used for an entire down payment, lenders didn't require proof of income, and low teaser rates lured homeowners in, but then later hit them with huge mortgage payments. In some cases, the loan principal that the homeowners owed actually grew. That's known as negative amortization, because their payments did not cover even the interest. Homeowners soon missed payments, and when values decreased, reducing the equity, homeowners couldn't refinance either. It's so much different this time. The risk of a crash from overborrowing is minimal, if not even non-existent. Reform after the financial crisis dramatically tightened lending standards. Today, homeowners aren't as squeezed. As a matter of fact, the total U.S. mortgage payments account for only 4.2% of total disposable personal income. That's the lowest level in at least 38 years. The rate was 7% before the crash of 2007. That period of time was an anomaly, and I'm going to explain what really happens to affect housing prices. A more conventional way for Southern California housing booms to end is through an economic recession. The last time that happened was 30 years ago, and that's when the aerospace and the military had cutbacks at the end of the Cold War. Job losses accelerated, and a national recession arrived in the summer of 1990. At that time, home prices in Southern California fell each month for nearly 6 years. The point I'm making is a recession will increase the odds of a home price drop due to higher unemployment, not lower unemployment. Today, in Southern California economy, it's more diverse and economic indicators remain strong. Unemployment is as low as 4.3%. So with continued economic strength and a shortage of housing, home prices will keep rising, only at a much slower pace because prices have exceeded what most incomes can afford. Until next time, this is Kevin Buddy, a mortgage specialist.